Build to rent has become a significant part of the housing and investment landscape on the East Coast, with tens of thousands of apartments already operating, under construction or planned across Melbourne, Sydney and Brisbane. In WA, however, the sector is still very much in its infancy, with only a handful of genuine projects delivered or in the pipeline. So the recent changes to the land tax settings, which were just passed recently, are therefore quite significant, as they may provide the additional incentive needed to help kickstart a larger build-to-rent market in Perth. At a basic level, build-to-rent differs from a normal apartment project because the building is not developed to be sold down apartment by apartment. Instead, it's held in single ownership and operated as a long-term rental asset. This means it's not just an apartment building, it's a large-scale investment product. That means the project has to work off long-term rental income, operating costs, vacancy, capitalisation rates and investor return hurdles, rather than just relying on strata sales to recover the capital that the developers and investors have put in. That's why I think it's important to separate true build-to-rent from government-backed rental housing projects. The government-backed projects such as 195 Pierce Street are still important as they will add to rental supply, but they're not quite the same thing. They're often supported by different capital, different policy objectives and different return expectations. A genuine private sector build-to-rent project has to stack up on commercial return metrics in a way that many subsidised or community housing-led projects simply do not. In Perth, the list of true build-to-rent projects is still quite short, as you can see here. For this map, I've excluded government-backed BTR, student accommodation and co-living buildings. The clearest completed example of true BTR in Perth is Sentinel Subiaco project, commonly referred to as the Elements. There are a range of projects under construction, including homegrown startup in Haberco, which has 51 units in Midland, which are almost complete, and Sydney Charles Quarter, which includes a smaller build-to-rent element within a wider mixed-use precinct. There's also SKS's Coburn development, which is under construction right now. Further projects are proposed across Perth, but construction commencements have been pretty low so far. So whilst this is a good start to have so many in planning, when you compare WA with the eastern states, you see that we're really lagging behind. BDO releases a build-to-rent report that tells the story quite well. WA has only 768 build-to-rent apartments across operating, under construction and planned stock. By comparison, Victoria has 24,855, New South Wales has over 17,000, and even Queensland has more than 6,000. That means there's 8 times more for Queensland than there is WA, and 30 times more for Victoria. So why then has Perth lagged so far behind? So in Perth, build-to-rent generally sits within the same planning framework as apartments, usually as multiple dwellings or often in mixed-use or higher density locations. So the planning system already has a place for it, and that's not really the issue. The main reason BTR has not expanded in WA is feasibility. The issue has not been rental demand. Perth clearly has very strong rental demand, and that's only going to grow with our high population growth. The issue is that build-to-rent is a harder model to make work financially. Construction costs in WA have been high, labour has been tight and finance has been expensive, and the locations where build-to-rent makes the most sense, inner and middle ring, high amenity, walkable locations, also tend to be where land is expensive and competition from other land uses is strong. In addition, the rental returns from most forms of residential are not very high generally, maybe 2 to 5%. From a commercial perspective, it's hard to get funds, lenders or institutions excited about taking on the risk of building an apartment building, managing the apartments and only receiving a subpar return when many other assets can provide 6+% comparatively easily. So why then are the returns so low? A few reasons. Apartments have been very expensive to build lately. Once built, you're then competing with private rentals in the market, and the risk of long-term vacancy is low. So for example, the vacancy rate in WA peaked at 7% during our mining downturn, and at the same time, the office market peaked over 40%. On the risk-reward matrix of investing, that generally means the returns will be lower. That's why the recent changes to the land tax law matter, as they acknowledge that economics have not quite worked well enough to get this sector moving at scale in Western Australia. Land tax affects build-to-rent harder than normal rental apartments because of the ownership structure. In a standard apartment building, the apartments are usually strata titled and owned by many different people. Some owners live in them and many pay no land tax, while investor owners are only assessed on their small share of the site. In build to rent, the whole building is held by one owner, so the land value is concentrated in one taxpayer's hands and assessed as one large investment asset. Because land tax is progressive, that can materially increase the annual tax burden. In addition, the government has recently announced a $75 million BTR Kickstart fund, which will provide no interest construction loans. I personally am in favour of this financial incentivisation and then letting the private sector solve the problem, as typically the private sector is faster and more efficient at delivery. I suspect build to rent will not ever be a silver bullet to fix our rental shortage, but it will eventually become a much more meaningful part of Perth's apartment market, particularly in good town centre and transit-oriented locations.